All right, so I'm doing this call to basically illustrate a few things. I want you guys to see how to properly follow signals, right? Um, so for the sake of, a better example, this is just a random chart that I chose, and we are going to look at this area right here for our selling position. It's actually when the market fell out the sky. Um, You know what? Forget that. Let's take it to a more reasonable time frame because we don't actually place orders based on the daily time frame. We may do analysis there. That's not where we place orders. The 4 hour, we may place orders there, but these are also more like swing trades. So let's just place a position based off where price is currently. And I want to break down basically risk and reward so you guys can understand what trades you should and shouldn't be taking. If a trade is already, gone too far, if you've taken too much time to actually enter in the position, there are a couple of things you should know as to whether or not that's a signal that you should enter into. All right. So the first thing I'm going to get into is risk and reward. And this is a concept that hopefully you already understand. Um, no exaggeration. So this is a 1-to-1, right? If this trade was sent to you, you would see it and you would notice your stop loss is the same size as your target, right? And our entry, I'll drag this line down here. That is our entry price. So we're really trading the breakout of this zone. And I'm not going to get too heavy into analysis, but just so you can see it, this is what we're trading, right? So we're selling it. Our entry is the blue dashed line, and the position that was sent to us looked like this. You wouldn't take a trade like this. The reason why is because if you took 10 trades like this and you won 50% of the time, you would not be profitable. So we don't take trades like this, right? If you're following signals and you don't know how to properly manage that signal once you're into it, the likelihood of you consistently being profitable if you don't know how to manage a signal also goes down too as well. So as a novice trader, there's some things that you could do just going in right off the bat that are controllable risk factors that have nothing really to do with analysis as far as entry, creating a bias, establishing trend, and just knowing exactly where you want to get in the market, right? And setting your targets and your own stop loss. But if you already have these parameters, you could figure out whether or not that's a trade you're able to enter into, right? So now I'm going to show you this. And we can see this is a 1-to-5 risk to reward ratio. This is also a trade I wouldn't recommend that you get into. Why? Because it's the same as the 1-to-1. The risk to reward ratio is not good. Relevant to you actually placing and taking positions, you losing once, the reward of you winning is 1.5 times the size of your loss. So let's say you lose 3 times, you're gonna have to win twice to break even. Now I'm gonna show you guys 1, 2, 3. All right. So 1-to-3 risk to reward ratio trade. What this means is basically you lose 1 time, you lose 2 times, you lose 3 times, and you win once, you're breaking even. So with the 1-to-1 trade, you lose once, you have to win again to be back at where you're at. Taking trades like this, you could lose 3 times and win once and be back to where you're at. So the benefits of taking risk to reward trades that are more than 1-to-2 at the very least. And I say 1-to-2 because if it is a trader who you actually trust their signals, they don't send out, you know, if they've never sent out 3 losers in a row, I would trust their 1-to-2 risk to reward ratio trades, right? That's because they're pretty good at sending out signals. So 1-to-2, same thing applies. Basically, you lose twice, you win once, you break even. So basically, what I'm breaking down to you guys, I'll show you something real quick out of the. All right, so just taking a look at this right here, we can see it's perfectly illustrated in this slide. you can see here taking 1 to 3 risk to reward ratio trades and winning 30% of the time, which means you lose a lot more than you win, right? So you win 3 trades out of 10 trades, you lose 7 trades. This perfectly illustrates how you could be a loser and still be profitable if you're consistent in taking 1 to 3 risk to reward trades. So we win 3 times, that's $900 in profit, and we lose 7 times, that's $700 in losses, right? So that's $200 as your profit total. And with the 1 to 4, your profits increase furthermore. And with the 1 to 2, you can see how if you're somebody who's not winning consistently, you will not be profitable. So I highly advise, as a novice trader, just beginning, you definitely follow signals, being aware of the risk to reward ratios. And now the final thing that I will show you is, let's look at this trade that's currently actually happening. And this may be a signal I send out to the squad. All right. So based off the previous market structure, we could set some targets. All right. And that's a target there. It's a target there. And here goes our final target. And I marked the ones green that are, the lines that are green represent take profits, right? The first dashed blue line is our entry price. That's this line right here. See me tapping it? It's that first one. The line between the green line and our entry price is our break-even point. So this is something else that is really important when you're following signals, right? If you're not doing your own analysis and you don't, if someone's not telling you what the break-even point is, which is something that I'll always do, because my number one job is protecting my capital. And especially when I'm leading and sharing my signals with other people, I have to make sure all of you guys are protecting your capital as well. So when we hit that first point of structure, where here in this example, at our break-even point, price could decide to turn around to respect the bullish structure that's already being created. So at that break-even point, what you're going to want to do is you're going to take your stop loss, and you're going to move it down into profit, right? You take your stop loss and you move it to in front of your entry point. And what this does, if price decides that it wants to go down here and then turn around to go back up here, instead of going into negative profit, right? Instead of losing capital, instead of going into drawback, right? Where we're now above our entry point, and since this is a selling position, we're not trying to buy, we'll now be losing capital. By moving our stop loss into profit, it'll allow us to break even. So these are very, very basic concepts that actually have a significant impact on your account. So setting a break-even point for every position that you take is something that's essential to being able to secure profit. Securing profits is ultimately how you make money. If you're focused on, trying to get rich quick or having that one big payout, you definitely won't make as much money as somebody who is looking to secure profit and put money in their pocket every single opportunity they get when trading this market. And the market is so unpredictable that ultimately, like, that's exactly what you want to do in order to make money. Some of my best weeks have been me just solely focused on securing profit, not hitting my final target or doing anything like that. But every time I'm making money, moving my stop loss into profit, breaking even, right? Securing profits at that first take profit level, securing profits at the final take profit level, right? Letting my trades ride out. And how do we do that? So how do we let our trades ride out? This is also very important. This is called a technical stop loss. So as our trades move into profit, let's say from here, it breaks out all the way down here, right? And we already moved our stop loss to our break even point, and we hit TP1. All right, so from TP1, price decides to go backwards a little bit to retest the impulsive move that was just created. And now it's going to continue down, right? It's approaching TP2. So what we'll do with our stop loss is we'll move our stop loss further into profit. So that way, when price does decide to turn around, we're securing even more profit. And this is something you can continue to do as the structure is formed in the market, right? And this is essential as well because ultimately, securing profit is how we build accounts. You want to put more money in your account at all times. So with this technical stop loss, price push down furthermore, we'll move our stop loss again until we hit that final target. So all of this money, right? Everything that's in this zone is secured. All of this is in your account. So I know a lot of people have trouble making money sometimes with signals when they're getting good signals sent to them. And it's because they don't actually know how to properly manage the trade once they're in it. So these are a few techniques that you can use: technical stop, breaking even, moving your stop loss into profit, securing profit. Also, I break down things like how to use a trailing stop loss, how to actually place your own stop loss. And there's multiple ways to do it. You have conservative stop losses. You have aggressive stop losses. You have stop losses that are right in between. And you want to take 5-star trades. You want to take the best opportunities that are presented. You don't want to focus on making money or hitting that big final target. You want to take as many trades as you can that meet your strategy. You want to find excellent opportunities. And when you find those opportunities, you want to be prepared for them by always calculating your risk, by being consistent with the risk amounts you're calculating. So that's the final thing that I'll mention is when you're doing your risk to reward calculations, the only way your risk to reward calculations will be accurate is if you're consistent in the amount that you're willing to lose. The moment you decide to risk more or less, your risk to reward calculations are not going to line up the same. So just looking back at this example, what that could mean is we take 3 trades, let's say, and for one of those trades, we decided to risk $50 instead of $100, and we lost 2 of them, right? And that one trade we decided to risk $50 on was the one we won. So we made $150, but we lost $200, right? So even though you hit that final target on your 1 to 3, the fact that you decided to risk less for this one because you were already losing is going to mess up your entire risk to reward plan. So whatever amount you are willing to risk, make sure it's an amount that you're comfortable losing so you'll be able to trade the next day, right? To take the next trade. Trading is about taking opportunities. And just now I just broke down a few things that'll make it easier for you to analyze signals when you receive them based off the time that you get them, where the signal is at, if the signal is still good for you to take. And you could apply this really to anybody who's sending you signals, right? So this is pretty basic information, and I hope it makes a difference in your trading.